Today, I'm going to be talking about how to invest your money to become a millionaire. Even if you don't have a lot of money to start with, it's possible to become a millionaire investor over time. The key is to start early and invest consistently. Even if you can only invest a small amount each month, it will add up over time, thanks to the power of compounding. So if you're serious about becoming a millionaire investor, be sure to watch this video. I'm going to teach you everything you need to know to get started. Stay tuned to the end of the video to learn how to become a millionaire in 5 or 10 years. Also, learn about the different ways you can invest your money. Let's get started. 1. Start early. To illustrate the power of compounding, let's consider Albert Einstein's words. Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. When you invest, your money earns interest. Compound interest means that interest is earned on both the original investment and the accumulated interest. This can lead to exponential growth over time. For example, if you invest $1,000 at 10% compound interest, you will have $1,100 after 1 year, $1,210 after 2 years, and $1,331 after 3 years. After 30 years, you will have over $17,000. The earlier you start investing, the more time your money has to compound and grow. For example, if you invest $1,000 at 10% compound interest for 30 years, you will have over $17,000. But if you wait 10 years to start investing, you will only have over $11,000 after 30 years. Compounding is a powerful force that can help you build wealth over time. The earlier you start investing, the more time your money has to compound and grow. Before I continue, if you're new here, please hit the subscribe button so you make sure to never miss my weekly videos on wealth creation tips. 2. Stay in the market. The longer you stay invested in the stock market, the more time your money has to compound and grow. Many investors lose money by following what Warren Buffett calls the fear and greed cycle. They buy stocks when prices are high because they hear that other people are making money. And then they sell their stocks when prices fall because they are afraid of losing more money. This is known as buying high and selling low. Investors who stay invested in the stock market through its ups and downs are more likely to make money in the long run. Research shows that the stock market rises more than it falls, and the longer you are invested, the higher your chances of making money and the lower your chances of losing money. For example, over the past 94 years, the stock market has been on the rise 78% of the time. The best way to make money in the stock market is to stay invested for the long term. Don't let fear or greed drive your investment decisions. 3. Invest consistently. Investing a lump sum in the stock market and staying invested for the long term can lead to healthy returns, but there is an even better way to build wealth: investing consistently. Consider 2 investors who started with $100,000 and invested it in a stock market index fund that earned 10% annual interest compounded quarterly. Mike did not add any more money to his investment, while Mary added $1,000 at the end of every month. After 5 years, Mike's investment would have grown to $163,862, while Mary's investment would have grown to $240,496. Even though Mary only invested an additional $60,000, that is, $1,000 per month for 5 years, she ended up with $76,634 more than Mike. This is because of the power of compound interest. The faster you start investing and the more consistently you invest, the more wealth you can build over time. This is why it's important to set aside a percentage of your income to invest consistently, even if it's just a small amount. Here are some tips for investing consistently. Set up a recurring investment plan with your brokerage firm. This way, a certain amount of money will be automatically invested from your bank account into your investment account on a regular basis. Choose a low-cost investment fund, such as an index fund. Index funds track a specific market index, such as the S&P 500, and they typically have very low fees. Rebalance your portfolio periodically. This will help to keep your portfolio on track to meet your investment goals. Investing consistently is one of the best things you can do to build wealth over time. It's important to start investing early and to stay invested for the long term. 4. Diversify your investments. Many people have lost a lot of money trying to find the next big thing in the financial markets. To invest successfully, you need to diversify. This means investing in many different stocks and bonds, instead of just a few. It's also important to invest in different industries. Diversification can be difficult for individual investors to achieve. That's why many investment professionals, including Warren Buffett, recommend that they invest in the S&P 500 Index Fund. This fund tracks the S&P 500 Index, which is a basket of 500 large-cap U.S. stocks. Another way to diversify is to invest in index funds or ETFs that track emerging markets and small-cap stocks. Many investors also include a certain percentage of bonds in their portfolios to reduce risk. No matter how you choose to diversify, the important thing is to do it to reduce your risk and prevent large losses in the market. Now that we've covered the 4 key principles of investing for wealth building, let's explore how to become a millionaire by investing. We'll look at 2 examples: how to become a millionaire in 5 years and how to make it happen in 10 years. Let's look at 2 examples of how to become a millionaire by investing in the S&P 500, assuming an average annual rate of return of 10.7% and quarterly compounding of dividends. Example 1. How to become a millionaire in 5 years. Case 1. You have no money invested yet. To reach $1 million in 5 years, you would need to invest approximately $12,821 at the end of every month. Case 2. You have $100,000 in your savings account and transfer it to your investment account. To reach $1 million in 5 years, you would need to invest approximately $10,648 at the end of every month. Please note that past performance is not indicative of future results, and this is just an example. The second example is how to become a millionaire in 10 years. If you invest in the S&P 500 for 10 years, you can become a millionaire by investing less money each month than if you were investing for 5 years. For example, if you have no money invested yet, you would need to invest approximately $4,757 at the end of every month for 10 years to reach $1 million. But if you have $100,000 already invested, you would only need to invest approximately $3,390 at the end of every month. This is because of the power of compounding. Compounding means that your earnings start earning earnings, and so on. Over time, compounding can have a significant impact on your investment growth. If you want to become a millionaire, it is important to start investing early and consistently. You should also diversify your portfolio and stay invested for the long term. By following these tips, you can reach your financial goals. I also want to add that it is important to be realistic about your investment goals. Becoming a millionaire in 5 years is a very ambitious goal, and it is not guaranteed. However, if you are disciplined and invest wisely, it is possible to achieve financial success. Now let's look at some ways you can invest your money. Stocks. Stocks represent ownership in a company. When you buy a stock, you are buying a piece of that company. Stocks can be a good way to invest for the long term, as they have historically outperformed other asset classes over time. However, stocks can also be volatile in the short term, and you could lose money if the stock market declines. Bonds. Bonds are loans that you make to a company or government. When you buy a bond, you are essentially lending your money to the issuer of the bond in exchange for interest payments over a period of time. Bonds are generally considered to be less risky than stocks, but they also offer lower returns. Mutual funds and ETFs. Mutual funds and ETFs are baskets of stocks or bonds. They can be a good way to diversify your portfolio and invest in a variety of different assets. Mutual funds and ETFs can also be a good option for new investors, as they can be purchased with relatively small amounts of money. Real estate. Real estate can be a good way to invest for the long term, as it can appreciate in value over time. However, real estate can also be a liquid investment, meaning that it can be difficult to sell quickly. Additionally, real estate requires ongoing maintenance and upkeep, which can be costly. S&P 500 Index Fund. The S&P 500 is a basket of the 500 largest companies in the United States. It is a good way to invest in the overall stock market and has historically returned an average of 10% per year. Other investments. There are a variety of other investments available, such as commodities, currencies, and cryptocurrency. These investments can be more risky than traditional investments, but they can also offer higher returns. It is important to do your research and understand the risks involved before investing in any type of asset. You should also consider your individual investment goals and risk tolerance. If you are not sure how to get started, it is a good idea to consult with a financial advisor. Investing can be a great way to build wealth over time. However, it is important to do your research and understand the risks involved before investing in any type of asset. I hope this video helps you in being one step closer to your financial goals. Please give a thumbs up on the video if you have enjoyed watching. If you have any questions, please leave them in the comments below. And be sure to subscribe to my channel for more wealth creation tips. I'd see you in the next video. Bye.